said, my background is I spent 20 years working for Barclays. I joined Barclays in the early 80s and then left in 2001 to set up a lending business myself, which did very well until the financial crisis of 2008 and 2009, when I was faced with the same difficulties that I now help people with in terms of dealing with a business that was significant difficulties. So when I was going through that process, I realised that, that certainly small businesses have little professional help that they can call upon unless they've got quite a lot of money to be able to go to big firms of solicitors to get specific financial help. So I set up AFT specifically to help those small businesses that might get into financial difficulties with lenders before they go into insolvency, or if the business is just too far gone and has to go into some form of insolvency, then we help people dealing with personal guarantees. And what does that mean? Well, what we are constantly trying to do is get lenders to do all sorts of weird and wonderful things for the benefit of the client. And what that means is, in the main, we get lenders to write money off for clients or reschedule the debt on more favourable terms. And naturally, they're not going to do that without some good justification. So we, in effect, write the business case that helps justify what we're asking them to do. And that will cover the financial aspects of the business or the person. It will look at the options that a lender's got for recovery and compare that to what the person can actually afford to pay. And most importantly, we then investigate the lending itself to see if there's any particular issues with the lending or with a guarantee that we can use to our advantage in helping bolster up a business case. But the ultimate objective is to find a solution that the client can afford and the lender or the person that got the guarantee can live with. So that's a little bit of background and how we got to where we are today.
I suppose there's nobody better really to understand the inner workings of the lending institutions, because I mean, how many years were you were involved in lending for, Gary?
It's best part of 30 years now, Chris, and I think then it's a really good point. It's almost like the more you can understand your opposition, the better deal that you can get for your client. And having been through the process and been on the receiving end myself in the financial crisis, you know, I can honestly say that I have got the T-shirt, if you know what I mean, because I've been there, done it, and the amount of notes on my particular problem in 2008, 2009 was far greater than anybody else that I've actually helped since, if you know what I mean.
I think that's really important. Obviously, similar to my story, I formed First Business Rescue after having to go through a liquidation process and just realizing that, hey, the advice out there was not tailored for the directors. It was weighted in favor of creditors, and I realized it was a bloody minefield out there. And it was from that I thought, right, this is how we'll create our business, protecting directors' interests. But it'd be really, I mean, Gary, without going into absolute minute detail, could you give us a little bit more about the story in 2008 and the figures that were involved? Just to
well, the business itself was lending something like £75 million. We were lending secured on property, so we were providing short-term lending secured on property. The means of clients repaying us was the sale or refinance of property. We weren't in it for the long term, and the financial crisis in effect meant that both of those options were in effect extinguished overnight. There was no refinance available because banks and lenders weren't lending, and the property market was such that nobody was buying properties either, so they couldn't pay us back, and so we had a major problem with our lenders at the time were NatWest. At the start, it was all fine, that we were in effect going to rent the properties out and just get through things. But when NatWest themselves went bust, We were then forced to liquidate the debt as quickly as possible and reduce the debt by £5 million per quarter. And that led to, let's say, disagreements with the major investors. And I found myself on the receiving end of a substantial court case. I don't want to go into too much detail on that, Chris.
No, I really appreciate your candidness. And
I mean, to give you an idea, Chris, the court case itself was 3 weeks in court.
And what was the value of the guarantees that you was? What was the figure that you was looking at being liable for? It was in the millions, wasn't it?
Well, yeah. I mean, apart from the fact I was liable for their legal bill, which was 1.75 million.
Wow.
And that was a loan. And that's after, I won on, I lost on 3 points out of 83, but I still got lumbered with a 1.75 million legal bill.
Wow. And I think it's really, it's worth noting, it doesn't really matter what the numbers are, whether it's in the millions or tens of thousands. When you sat at home at night, you're led in your bed, it's all that goes through your mind. And, it's the emotional and mental torture that we put ourselves through when we're faced with these problems. Which makes
totally agree, Chris. We can't, even now, when we're helping people, we can't just wave a magic wand and get rid of the pressure that they're under because of the issues surrounding the business or the impacts upon them personally. Mm-hmm. But with having somebody to help them through the process so that they don't have to deal with the person, the lender at the other end, whoever it may be, helps reduce those stress levels to a bit more manageable level. But one of the things, having been through it myself, the stress can affect your health, it can affect your family. And I say to everybody, if it does and it becomes unmanageable, money's irrelevant compared to your health and your family. And that's by far the most important thing. So stress management during the process is certainly a significant part of what we try and help people with.
Brilliant. Well, listen, again, I really appreciate you being so open with us. And let's start with the basics. Gary, what is a personal guarantee?
Okay, well, a personal guarantee is in effect an obligation to pay if somebody else doesn't, and so you would class it as a secondary liability, if you like. It only comes into play if somebody else doesn't pay. But most guarantees now are come with an additional clause. It's called an indemnity clause. So it's a personal guarantee and indemnity. And an indemnity can actually be a stronger route for the person on the other side, a lender mostly, because an indemnity is what you call a primary obligation. It's almost as if you borrowed the money yourself. And that does allow a bit more flexibility from a lender's perspective, because sometimes you can potentially get out of a personal guarantee, but then you'd be caught by the indemnity, and whichever one you're caught by, you still end up paying the same amount of money back.
And to give us a few examples, on just seeing this, that the people that are watching here are probably, there's some sole traders, there's some limited companies. In fact, there's a group of about 20,000 plus now that have joined the excluded community, a wide range of businesses and circumstances, but all of them fell through the cracks of the government support. People are living off fumes right now. The only thing that most people have been able to get is a bounce back loan that's debt. So if you could give us a couple of examples, that'd be great.
What of particular cases or circumstances, or
just put where may they where might a personal guarantee have been signed? Where might have somebody agreed to an indemnity?
Okay, well, starting with people like sole traders and non-limited liability partnerships, they won't. The guarantees don't apply to them because they have personal liability anyway. Mm-hmm. the difference with a limited company, as everybody will know, is that it's a separate legal entity, and so the debts of the limited company are separate to the directors and or the shareholders. But obviously, when you're in most lending circumstances where you're dealing with smaller companies, what the lenders are looking for is that personal involvement of the directors and owners of the company, and so they would, in the vast majority of cases, want a personal liability to cover any debt they lend to the limited company. And of course, that means that one of the benefits of the limited company being the separate legal entity is extinguished, because the guarantee provides that route to the individual in terms of liability. So most lending circumstances will have a personal guarantee and indemnity. You'll also find personal guarantees potentially in property leases, where you're committing to perhaps a 5-year lease on a property, and the landlord wants some reassurance that you're going to be there for the full 5 years, especially if they're doing some sort of rent-free period or something along those lines, and so they will want to incorporate a personal guarantee. A lot of people in the building trade may not realise that they've signed personal guarantees with things like applications for, you mentioned before, Dewsons or something, some builders supply. Most application forms will include somewhere within them a personal guarantee from a director, so that the building supply company can in effect go back to the director in the event of a failure.
Is there anywhere else that perhaps someone may have signed one unknowingly?
They can come in all sorts of areas, and I think one of the things that most people don't realise when they're in business is the level of protection that you've got in business compared to as a consumer is vastly different. As a consumer, you do have quite a lot of protection in that things have to be pointed out to you. They have to be done in a set format so that you know what you're doing. Mm-hmm. Whereas as soon as you become a businessman, all bets are off, and they can be in small print, in page 3 of the small print. They don't have to highlight them in the same way, because as a businessman and a director of a company, you're expected to know what you're doing. The starting point is, from a legal perspective, is that you know what you're doing, and if you don't read the forms properly, then that's your problem. There's no sort of legal defence as there would be for a consumer, where if you were a personal borrower going to your father or parents for a guarantee, there would be lots of protections for your parents to make sure they knew what they were doing. They couldn't just sign a form and there was a guarantee on page 3 that in the small print. So that's, I think, that the biggest thing I can say to people is these things can spring up in the least expected of places. Mm-hmm. And unfortunately, as a business person, if you don't read everything, which in fairness is probably impossible for everybody to do. I think somebody, I think it was on the news, they were doing a review of the terms and conditions for something like Zoom or something like that, and it was almost like a book. It was, and so it's almost impossible for individuals to read it. But sadly, as a director, you really have to make sure there's nothing in there that you could catch you out at a later date.
Gary, I just want to jump in. So we've got quite a lot of people on this Zoom today. If anybody has any questions that they would like to send me in the chat privately, start typing them in, and then I can field them to Gary and hopefully add a little bit more value to the people that are also following us over on our Facebook group. So if anyone does have any questions, please drop them in the chat privately to me. So Gary, one of the things that I wanted to sort of push you on really, what are the common misconceptions around personal guarantees? Because I mean, I hear this a lot. I've heard someone takes advice off somebody in the pub, about business debt, and it's surprising how many times that you know, we get advice of people who are not really the best people to get the advice from. So what can you bust some myths for
Yeah,
us?
absolutely. I mean, one thing I would say before, is, I'm not a solicitor, and AFT aren't solicitors. We specialise in resolving issues outside of a legal process, but by the very nature of what we do have to understand what the legal processes are and the potential implications. So some of the common misconceptions, we've already been through one of them, which is the lack of protection, and that you can't get away with saying I didn't read it or I didn't understand it or anything along those lines. That just doesn't work. I think one of the biggest ones that I get most of the time is if one, like a director, has signed a personal guarantee and, oh well, it can't affect my house because my house is in joint names and I've just signed the guarantee myself. My wife or my partner hasn't joined in. Well, sadly, that is not the case. Your partner or wife's or husband's share in the property is unaffected, but your share of the property is could very seriously be affected, in that there's normally two routes that somebody will go down to enforce the personal guarantee. One is to go for a county court judgment, the judgment route, and if they obtain a judgment, they can then apply for what they call a charging order, which gives them a charge over your share of the equity of the property. And they can then either decide to do nothing and just sit there, and at some stage, when you need to do something with that property, sell it or refinance it or whatever, you will then have to sort them out and pay them back with interest. Or they could apply to the court to, in effect, force the sale of the property on the basis it would be unfair for you to have an asset that you're not trying to liquidate to pay off your debts. So that's one route. The other route is they could go down the bankruptcy route, which is the statutory demand route. And of course, if you are made bankrupt, then again, your share of the equity in the house will ultimately have to be liquidated to pay off your creditors. Ultimately, because it's not something, either route, that they can do quickly. It takes time, and even with bankruptcy, it could take 18 months to 2 years after your bankruptcy for them to force the issue. But ultimately, it will be done. So I think that's the biggest common misconception around personal guarantees, that people believe that their own property is somehow safe.
I had so one of my experiences, and I wish I'd have known you back then, but when I had to liquidate, Gary, I was joint and several on a business overdraft with a bank for £25,000. And I didn't realise, but my partner at the time, they made an offer to the bank of, I think, £3,000 as full and final. The bank accepted it, and then I was landed with the remainder of the bill. And what I managed to do was I actually restructured that debt with the bank over a period of years and paid it down. But I was landed pretty much with the full amount, which was a real kick in the teeth. I did not understand joint and several. So, I have a feeling there's other people out there that won't understand that term. Could you explain what joint and several means, Harry?
Joint and several is a concept where two people or more have signed one guarantee document. So rather than you sign individual guarantees for £50,000 each, you've each signed a joint and several one for £150,000. And joint and several liability means that the lender can choose to go after one or all of the people that have signed it for any amount up to the value of the guarantee. So in your circumstances, they are quite entitled to say to one person, we'll accept £3,000, and then come after the other person for whatever's left, even if that was £100,000. Now, there's no obligation for a lender to split it evenly between the parties. They will just normally go after the path of least resistance. Who's got the most assets? Who's the easiest one to go after? And we'll probably go after them. Now, the other interesting part about that is, if one person has signed one guarantee document, that means that the lender can choose to go after one or all of the people that have signed it for any amount up to the value of the guarantee. So in your circumstances, they are quite entitled to say to one person, we'll accept £3,000, and then come after the other person for whatever's left, even if that was £100,000. Now, there's no obligation for a lender to split it evenly between the parties. They will just normally go after the path of least resistance. Who's got the most assets? Who's the easiest one to go after? you're the unlucky one and they come after you, and you do have to pay the full amount, you then do have a right of action yourself personally against the other parties for their equal share of the debt. But if they haven't got anything, that's somewhat irrelevant. So just be careful with joint and several liability. It's not 50-50 or a third, a third, a third. You could be on the hook for the whole amount.
So, Gary, one obviously question on people's lips at the moment. Many people have taken bounce back loans. Now, bounce back loan liability, if you've borrowed, I mean, it's a question that comes up. I hear it getting answered every day about limited companies. And it's fairly clear, but I'm going to ask you the question. Would somebody be held personally responsible for a bounce back loan if it was taken in a limited company?
I think the first answer is ordinarily no, but there's always a but.
Mm-hmm.
And the but is, have you complied with the terms of the bounce back loan?
Yes.
And the important factors there are the declarations that were made, which were very straightforward. I think there was only about 5 or 6 declarations that were made when you took the loan out, and it was all about at that when you took the loan out, or I think they calculated up to December, was the business solvent? I.e., you can't take loans out to a company that you know is going to fail.
Mm-hmm.
Now that doesn't mean if a company fails afterwards, you're automatically on the hook, because you're not. Because if you did it with the best of intentions and circumstances changed after you took the bounce back loan out, then that would be entirely a reasonable situation. The other issue with bounce back loans is they have to be used for business purposes and not for personal use. You can't go and buy a yacht in the south of France with a bounce back loan. And so the but here is, if you've not complied with the spirit of the bounce back loan, i.e. if you knew you were going to go into insolvency and yet you took it out anyway, and you've used the money for personal use, then there is routes that they could then come after you personally. I mean, technically, they could come after you for fraud. So you've got to be very careful in terms of, how and you've used the money. But I do want to stress again, if you took a bounce back loan with the best of intentions and something happened afterwards which caused the business to fail, then that to me is an entirely understandable situation.
I think, one of the, I mean, it's a question that we get all the time, and I am going to do a video on this after this webinar. But can people use the bounce back loan for salary? And salary is, well, go on, Gary. I'll let you answer it. The director, are they entitled to use some of the bounce back loan to pay themselves?
Well, again, I'm not an expert on this on this field, Chris, but my own personal view would be, if that was a legitimate business expense, then it should be entirely reasonable for you to pay legitimate business expenses. I mean, obviously, if you were paying yourself, £1,000 a month before, and all of a sudden you're paying yourself £10,000 a month, then questions may well be asked. But it's all about whether it was a legitimate business expense. That's my personal view.
Yeah, no, it's a question on people's lips, because the vast majority of people have always paid themselves a small element of PAYE with the rest as dividends. But sadly, because, this year, a lot of businesses aren't going to make a profit, by taking dividends, they're unknowingly building up overdrawn directors' loan accounts.
Yeah.
And it's this is a ticking time bomb. It was in the press the other day, and, I've got, as long as it's a reasonable salary, you need to change the way you're paying yourselves. And I'm going to do a video on that specifically in this group as a wake-up call, that if you are paying yourselves via PAYE and dividends, that needs to stop really, really quickly. So
we do help people with overdrawn directors' loan accounts who've fallen into that exact trap, Chris, if you know what I mean.
Yes.
Obviously, you can only take dividends out of profit.
Mm-hmm.
And if you or the capital of the business. So if you're not making profit and you've not got the capital built up in the business, then you can't take dividends. And so that would be classed as a loan. And if the business then went into insolvency, that loan would have to be repaid. And that's the problem where people don't realise. If they're taking it as a salary, they'd have had to pay tax on it, but far better to pay 20% tax than 100% of it back. And so that's it's a common thing, and insolvency practitioners are becoming very, very hot, if you like, on overdrawn directors' loan accounts in terms of pressing for their repayment.
And I think it's an interesting thing that you bring up there. You're not a solicitor, you're very open about that. We're not insolvency practitioners at First Business Rescue, because an insolvency practitioner is duty bound by their license to represent creditors, represent the people that you owe money to in a liquidation. So they can't be independent. They're there for the creditors as per terms of the license. So what we do is we stand next to you and get you the best outcome. We work with a large number of insolvency practitioners very, very closely, and a lot of people don't always realize that, Gary. So in respect of an overdrawn director's loan account, because I take calls throughout the day from people in this community, and a lot of them will knowingly have built up large directors' loan accounts. The business, right, today, November, there's no way forward for them. It's looking like liquidation is the only option available to them. Could you just walk us through what happens in that circumstance? An overdrawn director's loan account, what would happen from there?
In terms of what, the dealings with the insolvency practitioner in due course?
Yeah, so the service that, just to
Well, I think it's a very similar sort of approach that we do with any lender. At the end of the day, we've got to review the financial position. An insolvency practitioner's job is to collect assets and liquidate those assets, but they've got to be reasonable to creditors in that respect. So if there is an asset of an overdrawn director's loan account for an amount of, let's say, £20,000, they have to explain to creditors why they have agreed a payment plan or a settlement of whatever they do. Obviously, if you get the full 20,000 back, fine. But obviously, we're always trying to minimise what a director has to pay, whether that be from a guarantee or it has to be a director's loan account. And so if we're going to ask a bank, the IP or whatever, to accept £5,000 instead of 20, we have to explain why they should do that. And so that will involve a review of the financial position. And in fairness to IPs, they will actually then take a view on the collectability of that debt, because they're not going to spend 10 grand to recover 5. It doesn't make any commercial sense to do so. One thing that people must be aware of is that with overdrawn directors' loan accounts, a lot of people have used set-off to reduce what they have to pay, and there's a common law right that if you owe the company or you owe somebody some money, but similarly they owe you some money, you net the two off and pay the difference. But with overdrawn directors' loan accounts, sometimes IPs class that as what they call misfeasance. And misfeasance is where a director's done something wrong in terms of the running of the company, and in those circumstances they try and avoid allowing set-off, because if you owe the company £20,000 but have a guarantee to, say, Funding Circle, for instance, and have had to pay Funding Circle £20,000, you would think you would be able to net one off against the other, and so there would be nothing to pay. But if the IP then wants to make an issue of misfeasance, then they will say that you're not allowed to offset that debt, and you could end up paying that 20 grand twice. So just something to be aware of.
I think, I mean, it sort of further highlights that the minefield that there is in front of people. And if anybody does want to speak to us, I'll drop a meeting request into the comments, and you know, they'll be absolutely free, independent, off the record advice, no strings, no obligation. And we're also going to be forwarding Gary's details at the end of the webinar. Gary, can you give us some examples? I mean, I know you've done you've helped us out with some clients we've introduced to you over the past couple of months. Could you give the audience some examples of how this has worked, and you know, some success stories? Because I think it's really important to have hope in this. You know, it's there is something that can be done about these things.
Absolutely. I think that's why I always tell people about what happened to me, is because it does show that you can come out of this. There is light at the end of the tunnel. You can rebuild yourself, and there is a future. First thing that any lender will want to do with any personal guarantee is get the person at the other end, the director, whoever it may be, to accept that they are liable for the debt. That's just one thing that everybody's got to be aware of, is, you know, if you're going to get help, do get help, because they can lull you into the false sense of security of admitting the liability when that might not be the best thing to do. So in terms of some specific examples, I have got somewhere we can talk specifics without names because clients have allowed me to do so. Others are just more generalized. As you know, we've just helped one of your clients, Chris, where they had a £68,000 liability to a lender that specialised on providing finance secured by future credit card receipts. And that person had unfortunately had to go into insolvency. They'd set up again, but they had this liability to deal with. Mm-hmm. We did find a few issues with that particular case, and we managed to get a settlement of £15,000 payable in 3 instalments. So from that client's perspective, they were absolutely delighted, because not only have they saved £50,000, but they've also been able to carry on trading again through new limited companies. I can give you a more specific example where a client, they were running a nursery, and they'd got behind with the tax and had a big tax bill, and an unscrupulous finance broker had got them into an expensive bridging loan secured on their property to pay off not even all of the debt, a small portion of the debt. Now, they did it without the revenue agreeing to the situation. The revenue didn't agree to the situation. Ultimately, that client had to go into bankruptcy. But obviously, during that time, the partner had signed over the property to secure this debt. Now, the interesting thing about this one was when we got involved, they were due in court the following week on a possession order where the lender was going to take control of this property. And the property was a nursery with a flat above. Now, we managed to find some serious issues that they hadn't. These were unregulated lenders. And when you calculated the percentage of the flat of the property, it fell under a regulated mortgage contract. It should have been a mortgage, not a commercial lending. And so we got the court initially to defer everything whilst this was investigated. And ultimately, the lenders had to pay back to the partner that wasn't bankrupt 50 grand, which was a fantastic result because they were going to lose absolutely everything.
So you're looking at technicalities of things. You know, are you trying to find a hole? And
we're always trying to find anything we can that lenders have not done quite right, because that will help bolster up the business case to justify why we're asking them to accept 20 grand instead of 50 grand or 50 grand instead of 100 grand. Mm-hmm. So yes, we are always looking for issues. Now, the vast majority, the issues are a bit more mundane. They'd perhaps not dotted the I's and crossed the T's, but ultimately, if he went to court, they'd probably win. But that's not the point. The point is we're trying to use those to bring them to the table to find a satisfactory solution. Occasionally, like with this particular case I've just mentioned, there are far more significant issues that you would want to, in effect, risk going to court on. And I'll give you another example of one where the client thought they had a significant issue, but when I spoke to them, realised they've actually dug themselves deeper. And this is where a major lender, I'm not going to mention names on this one, a major lender was providing specialist car finance. And they wanted to change the terms, not for the benefit of the borrower, but for their benefit. And obviously the borrower was not happy and they were putting it off. And eventually the manager rang them up and said, I'm going to come and pick the facility letter up tomorrow. He turned up and the owner, who still was trying to avoid signing it, said, well, I'll sign it, but my wife won't sign, thinking he'll go away. And what that manager then said is, well, have you got anything with your wife's signature on? Because if you hold that up against a window, you can trace a signature onto the document. We do that all the time. Right. Now he thought, brilliant, that document's not worth the paper it's written on. But then I asked him, well, who actually did it? He said, well, I did. I said, well, you've just committed fraud. You might have been, so is the bank, the manager, if you like, but you've committed fraud. And so all of a sudden, we get to a situation whereby he thought he was free and clear, when actually his position was absolutely a damn sight worse. His wife was fine, but his position was significantly worse because the innocent party here was the lender. The people that had done the wrongdoing was the manager encouraging this guy to do, falsify his wife's signature onto a document. So we ended up having to change tack with that one. We got his wife off without a problem, but we couldn't raise the issues because raising the issues in depth would have dropped him in the mire a lot more. We still got a solution, but it wasn't the one he wanted at the start.
I've had quite a lot of people that I've spoken to recently that they've had, like you said, the merchant terminal advances. That I think they've been quite aggressive taking market share. Or people working with the likes of sort of iWalker, Funding Circle, Capital on Tap, Just Cash Flow. Have you any experience with those lenders, Gary?
Yeah, every one of them. We've done. I mean, there are thousands of lenders out there now. So every now and then you do get a name that you've never come across before. Some lenders are more difficult to deal with than others, and Funding Circle are one of the most difficult ones to deal with. Because they don't like admitting that they've got problems. They've almost got blinkers on. We do solve things out. We do sort things out with Funding Circle, but they are a lot more challenging to deal with compared to even a high street bank, who have been, because they've been in business for hundreds of years, they know the reality of the situation. And the main difference between Funding Circle and most other lenders is it's not Funding Circle's money. So they've not got the same accounting principles that they have to gather. If you're lending your own money, and you've got to recognise bad debts, whereas if it's not your money, you don't. So your business doesn't have to recognise the situation. Your issue then is with your investors, and so they don't like giving investors bad news. But most lenders will be at least willing to consider proposals if they're structured in a way that makes sense to them. What they won't consider is proposals that don't make sense to them, and that's the key aspect.
And Gary, how do people know whether something makes sense? We're happy to have chats with people, aren't we? And
absolutely. We will always have free, no obligation, totally confidential chats with somebody just to see if it makes sense, because most of our fees are based on success, Chris. So we're not going to take something on that doesn't make sense to me in terms of a potential solution. And part of our role, is initially when you're looking at the asset position, is every case is different. Some people, there's an element of protection. If you've got £1 million house with no mortgage, you've got a lot more to lose than somebody who's got £100,000 house with £100,000 mortgage and no equity in it. And so protection is part of the process. And people sometimes have unrealistic expectations. And what I mean by that is, if somebody is sat on £1 million house with no mortgage and the lender knows about it, they're going to fight tooth and nail to get every penny back. And unless they've made a right mess of it, they probably will. And the key aspect with that is it's all about protection. What you don't want to do is be forced to have to pay that 100 back tomorrow, which could be the case. And then you might have to force sale your property asset and lose more money selling it, as well as the 100 grand that you've got to pay back. It's all about finding a solution that gives you the ability to pay that back over time. And of course, if when we do the investigation they have made a mess, then we can revisit the debt forgiveness side as well. And sometimes it can be a combination of the two. So it's all every circumstances are different. Every case is different. Yes, I can quote you specifics in terms of what average savings we make, but it's not relevant because every case is different. What might be right for one is not going to be right for somebody else.
Well, I mean, I know just the few recent ones that you've completed. They've been great results. I mean, one of our clients who passed over, who's had serious health issues, I know, what you've done for them has made this time a little bit more bearable. And I think it's only fair that we talk about what it is you charge, because that's another thing I've been really impressed about, Gary, is, if you can help them, you'll help them, but you're very transparent with your fees, and you're very, your client care's outstanding. So what does it, if somebody, obviously they talk, they have a chat, there's no obligation, and the initial advice is free, exactly the same as myself. But if somebody wants you to go on and take a job on, what would it cost?
Well, customer care is fundamental to what we do, Chris, because obviously having been through it myself, I understand wherever everybody is that I'm talking to, I can honestly say to them, I've been there and I understand it. So customer care is pivotal. But we do have to earn a living out of it. But most of our fees are based on success. We would much rather get well paid if we succeed, rather than getting paid whether we win, lose or draw. So we charge a small amount up front, depending on how many guarantees the client is asking us to review and look at. And then once that's paid, and that can be paid in instalments, there is then no other charges, no matter how long this takes, whether that be 2 or 3 months or 2 and 3 years, unless we get a solution that the client is happy with. And that would either be a reduction on the debt or a payment plan, whatever it might be. If we get a reduction on the debt, we charge a percentage of what we save, between 10 and 20%, depending on the amounts involved. And if the objective is to get a payment plan, we will agree a fixed fee if we are successful in getting that payment plan. But the key aspect there is no further charges are made unless the customer and, of course, the lender or whoever's on the other side agree to the solution. We can't force either parties to agree to it. They both have to agree to it.
I mean, we're sort of coming up to time. That there is another question that I was asked by one of the gang on Zoom, and it's with regards to. So, if anybody else has any more questions, please feel free to drop them in the chat. I'm also going to drop into the link the meeting request if anybody would like to book a meeting. And Gary, it was about CBILS. So what are the PG implications on CBILS? What experience, what have you seen so far?
Well, in terms of ones that have gone wrong, we haven't seen anything yet because the payments don't start till next year. So unless the company's gone bust for something else, that we haven't actually seen anything. Seabull's, from memory, because we're not brokers here, Seabull's up to, I think it's 250,000. There's similarly no guarantee requirements for that, as far as I'm aware. But over that figure, there are. Seabull's is very similar to what they used to be called the Small Firms Loan Guarantee, or the EFG scheme that lenders do, where the government guarantees up to 80% of the lending. Mm-hmm. If you have got one of those old schemes, you will have had to give a personal guarantee. And I think one thing you've got to be aware of with those old schemes is that the guarantee is not for the percentage that the government don't cover, i.e. 20% of the facility, it's for the whole lot. And that's something that people don't realise. We have dealt with quite a few of those, but I've not actually dealt with any specific cases yet. Guarantee. But the principle would be that the lender would be duty bound to take all reasonable steps to recover money under that guarantee before they claimed on the government guarantee.
Yeah.
Well, the key aspect with that is reasonable, all reasonable steps.
Okay. Brilliant. Well, I mean, Gary, it's been fantastic to have you on here. So, you know, this is a time to plug your services, please. But where, if somebody wants to speak to you directly, where would you direct them to?
Well, as I said before, we're always happy to have a chat with people who are in difficulty, even if it's other bank-related matters. We're more than happy to share my experience with people. We'll guide them in the right direction if we can't help them ourselves. Please feel free to visit our website. That will provide more information about what we do, and that's www.aftassist.com. I think you're going to put my contact details in somewhere, Chris, but I'll put my mobile in so they can call me directly on my mobile and have a chat. No problem at all. If they want to email me, the email is just Gary with one R at aftassist.com. But if they come through you can also point them in the right direction, and I'll happy to have a chat. I think the key thing I would say to everybody here, not just because of the debt, but because of the stress that it can take, is please talk to somebody if you're worried about something, whoever that may be, whether that be a friend or your partner. Don't keep it in yourself, because it will just fester. And of course, please feel free to give me a call if you want to just have a general chat. I say there's never any obligation. If you just want to have a chat and then do your own thing, that's fine by us. If you want our help, we'll be gladly to get involved if we can.
So we're going to come out of the Facebook group now. There's a couple more questions coming through, but obviously you'll see videos of me fairly regularly, and if anybody wants to reach out or they've got any questions, please let us know. I can also put you in touch with Gary. So we're just going to come out of Facebook now, guys. Everybody that has watched us in the excluded community, thank you very much for doing so. And we are here to help serve and assist and assist the members of Excluded. So once again, thank you for your time. Okay. So we've stopped in Facebook, guys, but you know, everyone's still on the call, so it's you've been great, Gary. You know, really helpful.
Well, as long as it was helpful to people, that's all that matters.
Well, we've got an inquiry here. There's someone who signed a 15-year lease on a high street premises in February 2020. 6 weeks later, after fitting a new shop front and starting major fit-out works, COVID hit. The retail unit has not been able to open and has been refused all government grants. Now, in August, they haven't been able to pay the rent. The landlord is now trying to issue a stat demand, as he is the PG on the lease for the limited company. Any advice to this person, Gary? Or do you think it might be worth having a chat?
Always worth having a chat. I think one of the things you might want to have a look at, just thinking outside the box, is there anything in the lease that covers force majeure or something along those lines, where things outside of your control could limit your liability. If there isn't, have you got any insurance that might cover that? There's a big insurance case going through the High Court, the Supreme Court actually at the moment, for business interruption. If not, and you are potentially liable, then we need to have a chat to go through your personal circumstances and see what, if anything, we could do to potentially help, or at least point you in the direction. So more than happy to have a chat. It's not appropriate to do it in an open forum because I'd need to talk about personal information.
I'll get you guys connected. So I've just him personally. And is there any, you've got us here, guys. Is there any? I mean, has this been helpful to people? Has it answered any of your questions? Do you know what? I'm gonna. You can all unmute who wants to. Is there anything else we can help you with, guys and girls?
It's always a difficult topic to discuss in open forum, Chris. So it's.
Can we get Gary's phone number again, please?
Of course, I'm going to drop it into the chat now. Just bear with me. Gary's direct mobile number is everyone in the meeting. Can everyone see the group, the chat, guys? No worries. Phil, good.
Yeah, thank you.
Everybody got that. Please just feel free to just give us a call. There's never a problem. Just obviously mention where you got the details from, and more than happy to have a chat at a later date.
Well, I really appreciate everyone who's taken the time out to listen to us. You know what, Gary, it's been really well supported and viewed this. So without further ado, I'm going to close the meeting now, and I wish everybody the very best, and I'm sure that we'll touch base soon. Gary, thank you very much.
Pleasure, Chris. It's been really good to get involved, and hopefully it's answered a few questions and given people at least an opportunity of talking to somebody if they need it.
I think we've had some really kind comments, mate. Listen, Gary, I'll catch you soon. Take care, mate.
Super. Thanks a lot.
Thank you.
Thank you.
Thank you. Bye-bye.